Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the financial world and try to make sense of what these corporate filings actually mean for the companies and for us. Today we got a real deep dive into Nuveen. Now this is an annual report, a certified shareholder report, and it is packed with a lot of numbers and a lot of details about their investments. Let's see if we can crack the code on what Nuveen has been up to. Before we jump in, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We've also got a Discord community linked in the description below where we break down these filings even further. So Nuveen Floating Rate Income Fund and several other Nuveen funds have just released their annual report for the fiscal year ending the 31st of July 2025. It's a chunky document covering their investments, financial health, and strategic moves. We were going to focus on the most interesting parts, especially the financial tables, to understand where the money is and what risks they're retaking. Think of it like reading a company. S-report card some subjects might get an I, others might need a bit more work. Let's start with the Nuveen Floating Rate Income Fund, or JFR for short. Their total return as of the 31st of July 2025 for the 1 year period was 6.37% at NAV. That means their investments were worth about 6.37% more by the end of the period, after accounting for all their expenses. However, they did trail the S&P US Leveraged Loan Index, which returned 7.60%. So, while they made money, they didn't quite keep pace with the market average in that specific benchmark. Looking at their shareholder price return, it was a much more impressive 8.66%. That is the return you'd get if you bought and sold the shares on the stock market. The difference between NAV return and share price return, especially when the share price return is higher like this, tells us something about how the market views the fund. One of the key things about this fund, and many like it, is leverage. This report shows JFR has an effective leverage of 36.09%. This means they're borrowing money to invest more than their own capital. It's like using a credit card to buy more stocks. It can amplify gains, but it also amplifies losses. They state this leverage is used to opportunity for additional income, which makes sense if the cost of borrowing is less than the return on investments. Now let's break down the assets for JFR. Variable rate senior loan interests make up a massive 139.3% of their net assets. This is the core of their strategy, investing heavily in loans that adjust their interest rates. Corporate bonds are next at 17.5%. What's interesting is that common stocks and preferred stock are barely there, at 1.5% and 0.0% respectively. This tells us they are really focused on loan instruments, not as much on traditional stocks or preferred shares. For credit quality, a huge 86.4% is BB or lower, meaning it's considered below investment grade. This is where the higher income potential comes from, but also the higher risk of default. Next up, Nuveen Credit Strategies Income Fund, or JQC for the same one. Year period, JQC returned 7.06%. Again, this was below their benchmark, which returned 7.84%, but their share price return was a healthier 8.35%. Their effective leverage is a bit higher at 37.09%. Their asset allocation is similar to JFR, with variable rate senior loan interests at 117.1% and corporate bonds at 31.8%. Their credit quality is also heavily weighted towards the riskier side, with 82.8% in BB or lower rated investments. Moving on to Nuveen Preferred and Income Opportunities Fund. JPC, this one shows a strong one, year return of 10.29% at NAV, beating its benchmark of 8.44%. Their share price return was even more impressive at 16.10%. This is a fund that is significantly focused on corporate bonds, taking up a massive 140.8% of net assets. This is a very high concentration, and it means their performance is heavily tied to the corporate bond market. Their effective leverage is 37.04%. The credit quality here is more heavily weighted towards investment grade, with 77.0% in BBB. Now for Nuveen Preferred Securities and Income Opportunities Fund, JPI, this fund also posted a strong one, year return of 10.34% at NAV, outperforming its benchmark of 8.44%. Their share price return was a stellar 13.79%, similar to JPC. They also have a very high concentration in corporate bonds at 136.8% of net assets. This fund also has a high percentage, 73.9%, in BBB rated corporate bonds. Finally, Nuveen Variable Rate Preferred and Income Fund. NPFD, this fund had a 1 year return of 10.09%. also outperforming its benchmark of 8.68%. Their share price return was a strong 14.97%. Their portfolio is heavily weighted towards corporate bonds at 137.6%. Around 71.8% of their investments are rated BBB. Let S look at the statement of assets and liabilities for JFR as of the 31st of July 2025. They have total assets of over $2.3 billion. A huge chunk of that $2.25 billion is in long-term investments. Their liabilities are also substantial, over $894 million, with borrowings alone being over $517 million. This leverage is a key factor in their strategy. Their net assets, what is left for the common shareholders, are about $1.42 billion, and the NAV per S-share is $8.82. For JQC, the numbers are smaller, but the picture is similar. Total assets are around $1.39 billion, with long-term investments making up the bulk. Liabilities are significant too, at over $559 million, with borrowings at $211 million. Net assets are about $837 million, and the NAV per S-share is $5.66. JPC shows much larger numbers. Total assets are over $4.2 billion, with long-term investments at a massive $4.1 billion. Liabilities are also very high at close to $1.6 billion, with borrowings at a staggering $649 million. This fund is using a lot of leverage. Net assets are about $2.6 billion, and the NAV per S-share is $8.01. JPI has total assets of around $448 million. Long-term investments are $438 million. Liabilities are significant at $166 million, with borrowings at $118 million. Net assets are about $282 million, and the NAV per S-share is a healthy $20.01. Lastly, NPFD has total assets of about $765 million, with long-term investments at $750 million. Liabilities are around $280 million, with borrowings at $161 million. Net assets are close to $485 million, and the NAV per S-share is $20.06. Let S glance at the statement of operations. This shows how each fund made and spent money. For JFR and JQC, the main income driver is interest from their investments, which makes sense given their focus on loans and bonds. Expenses are also significant, especially management fees and interest expenses related to their leverage JPC, JPI. And NPFD have very high dividend income, which is expected given their focus on preferred and income. Producing securities. Interestingly, JPC had a significant realized gain from investments of over $16 million, while JFR and JQC had realized losses. JPC also shows a substantial change in unrealized appreciation of over $62 million, which is a big chunk of their overall net increase in net assets. Looking at the statement of changes in net assets, JFR and JQC both saw significant inflows from their rights offerings in 2025, bringing in over $220 million and $62 million respectively. JPC also had a huge increase in common shares from a merger, adding over $1.5 billion in net assets. JPI had a massive decrease of over $173 million due to a tender offer where they bought back shares. And now for the juicy part, the portfolio of investments. This is where we see what they actually own for JFR. It is heavily dominated by variable rate senior loan interests, accounting for almost 140% of net assets. Remember, this is leverage, so they're borrowing to invest in these loans. The biggest chunk here is in capital goods, followed by commercial and professional services and consumer services. Almost all of their debt holdings are rated BB or lower, meaning they are lower quality and higher risk, but also offer higher yields. For JQC, it is a similar story with variable rate senior loan interests at 117.1% and corporate bonds at 31.8%. They also have a significant exposure to asset-backed securities at 7.9%. Their top sectors are software and services, healthcare, and consumer services. Again, credit quality is heavily concentrated in the BB or lower category at 82.8%. Scroll corporate bonds, 140.8%. Sripri JPC is heavily invested in corporate bonds at 140.8%. Their top sectors are overwhelmingly banks at 54.3%, followed by financial services and insurance. What is really notable here is their credit quality. A massive 77.0% is BBB rated. This is higher quality than JFR and JQC. JPI also has a very large allocation to corporate bonds at 136.8%. Their top sectors are also banks, 52.1%, financial services, and insurance. Similar to JPC, their credit quality is concentrated in BBB at 73.9%, and NPFD follows suit with corporate bonds at 137.6%. Their top sectors are banks 44.2%, financial services, and insurance. Their credit quality is also BB, rated heavy at 71.8%. Now let's talk about the risks. The report lists out what keeps these funds up at night, and it is quite a list for JFR. You've got basis risk, below investment grade risk, call risk, and CDI CLO risk. The fact that they're heavily into below investment grade debt and leveraged loans means they're chasing higher yields, but taking on more risk of default and volatility. The report mentions that for JFR, they focus on larger, more liquid issuers, which is a smart move when you're dealing with potentially riskier assets. Their top contributors to performance were exposure to single B loans and security selection in tech and communication services. But they were dragged down by out-of-benchmark equities from reorganizations and exposure to financials and energy sectors. PricewaterhouseCoopers LLP or PwC signed off on these financial statements for the year ending the 31st of July, 2025. They expressed an unqualified opinion, which is good news. It means they found the financial statements to be fairly presented. The old auditors, KPMG, had also given an unqualified opinion for the prior year, which is also a positive sign of consistency in their financial reporting. The auditors spent a lot of time confirming the securities held by the funds, which is important given the complexity and volume of investments. This section details why the Board of Trustees decided to renew the investment advisory contracts. They looked at a lot of things: performance compared to peers and benchmarks, fee structures, the quality of services provided by Nuveen Fund Advisors and Nuveen Asset Management, and even the profitability of the advisors for JFR. And JQC performance was below benchmark for longer periods, but better over the last year. JPC, JPI, and NPFD had mixed performance results compared to their benchmarks and peer groups. The advisory fees for most funds were below the median, which is a good sign, though NPFD showed actual management fees slightly above the median. The report emphasizes that no single factor was controlling, but a comprehensive review was done. For tax purposes, none of the funds designated any distributions as being from net long-term capital gains. This means most of the taxable income shareholders received was likely from ordinary income and potentially returns of capital. JPC, JPI, and NPFD have a very high percentage of ordinary income distributions treated as qualified dividend income for individuals, which is generally taxed at a lower rate. This is a plus for individual investors. So, what is the big story here? Nuveen's funds are heavily leveraged, particularly those focused on loans and corporate bonds seeking higher income. This comes with significant credit risk as a large portion of their holdings are below investment grade. The preferred and income funds, JPC, JPI, and NPFD, focus on corporate bonds and financial services, showing stronger recent performance. JFR and JQC are chasing yield in the loan market, which is inherently riskier. Leadership changes and fund mergers also happened, and the report details their strategic decisions. The key takeaway is that these funds are actively managing complex portfolios with significant leverage, aiming for income generation, but this also means higher risk for investors. The substantial focus on below investment grade debt and variable rate instruments means they are sensitive to interest rate changes and credit cycles. What is your take on these Nuveen funds? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button, subscribe if you haven't already, and ring that notification bell so you don't miss our next deep dive. And if you want to connect with other finance enthusiasts and discuss these reports, join our Discord community linked in the description. Thanks for watching, and I'll see you in the next episode of Corporate Decoder.